If you have like $5 million in the bank, the absolute worst thing you can do to pay for a long-term care event is, well, write a check out of pocket.
Right. I mean, it goes against every single instinct you develop while building wealth.
Yeah, exactly.
You just assume that accumulating this massive portfolio means you've insulated yourself. You look at your net worth and just think, I can cash flow whatever medical hurdles come my way.
But today we're completely dismantling that exact myth. We are doing a deep dive into this really comprehensive strategy guide meant for the 1715 Treasure Coast Financial Wellness podcast. It's put together by Davies Wealth Management, which is a fee-based fiduciary advisory firm down in Stuart, Florida. And reading through this material, the massive aha moment for me right up front is that insurance for high net worth individuals operates on a completely different set of rules.
Oh, entirely. Yeah.
We aren't talking about like buying medical coverage. We are talking about defensive asset preservation.
Yeah. Right, because mass market financial advice treats long-term care as this binary consumer purchase, like you either buy a policy or you don't.
Yeah.
But when you apply that logic to portfolios of $2 million, $5 million, or $10 million, it just totally falls apart. The affluent often fall into this trap of assuming self-insurance is the logical default.
Just because the money is sitting there.
Exactly. Just because they have the liquidity.
So let's look at the actual mechanics of why that self-insurance default is so dangerous. We're starting with some pretty sobering statistics here from the U.S. Department of Health and Human Services.
Yeah, these are wild.
Roughly 70% of Americans turning 65 will need some form of long-term care. 70%. And the baseline cost for a private room in a nursing facility, it's hovering around $115,000 a year nationwide.
And that's just the baseline. I mean, in coastal or metro markets like where Davies operates in Florida, you're easily looking at over $150,000.
Right.
But, the real danger for high net worth individuals isn't just that sticker price. It's the duration.
The duration? What do you mean?
Well, wealthier individuals generally have access to better preventative health care, right? Optimal nutrition, lower occupational stress throughout their lives. Consequently, they live longer.
Right.
But that expanded lifespan doesn't automatically equal an extended health span. So when physical or cognitive decline eventually happens, they often survive much longer in a diminished state.
Oh, wow. Okay, so instead of the generic, 2 to 3 years of care that those mass market planning articles always cite,
Exactly.
we are looking at an extended morbidity phase. A slow cognitive decline could necessitate round-the-clock care for 5, 7, or even 8 years.
Yeah, and then you have to layer healthcare inflation on top of that extended timeline.
Yes, inflation.
Right. Healthcare costs compound at roughly 5% annually. So if you're 55 now and looking at a potential care event at age 80, that compounding math is just brutal.
It's exponential.
Yeah. A $120,000 annual cost today balloons to nearly $195,000 in just 10 years.
That's insane.
Multiply that by a 7-year care event, and you are bleeding millions of dollars from the portfolio.
Which introduces the single most destructive mechanism to a retirement portfolio, right?
Right.
Sequence of return risk.
Oh, absolutely. The silent killer.
It really is. I was thinking about it like this. It's like treating your carefully balanced retirement portfolio as an unlimited checking account while the stock market is crashing.
That's a great way to put it.
If I need $150,000 to pay for premium home health care and the market is going through a 20% correction, I'm not just pulling out $150,000. I'm being forced to liquidate shares that used to be worth nearly $200,000.
Exactly. You're locking in those losses. Those shares are gone forever. They can never participate in the eventual market recovery.
Right. You're selling at the absolute bottom.
You permanently impair the portfolio's compounding engine. Even an $8 million portfolio can suffer irreversible structural damage if you're forced to systematically sell off your best performing assets during a prolonged bear market.
Just to cover nursing costs.
Just to cover the nursing costs, yeah. And the collateral damage to the healthy spouse is severe.
Yeah, they have to just sit there and watch their shared nest egg evaporate.
Which radically alters their own future financial security. So, if paying annual premiums for traditional insurance feels like throwing money into a black hole, because those old standalone policies are famous for massive arbitrary rate hikes.
Oh yeah, those are terrible.
Right. But the alternative isn't not paying. The alternative is repositioning.
Repositioning. Okay, so if self-insuring is a trap and traditional standalone policies are famously awful, what is the alternative? How are the wealthy actually structuring this coverage?
Well, the traditional use it or lose it insurance model has largely been abandoned by affluent families for that exact reason you mentioned. Nobody wants to pay premiums for 2 decades and then pass away peacefully in their sleep, having forfeited all that capital to the insurance company.
Nobody. It feels like a scam.
It does. So the modern mechanism relies on hybrid policies. These fuse life insurance, or sometimes an annuity, with long-term care benefit.
Okay, wait, let me push back on this for a second. If I lock up, say, $200,000 in a hybrid policy, and then I step off a curb and get hit by a bus tomorrow, isn't that money just gone?
No, actually, that's the genius of it. The underlying math is entirely built around the concept of a return of premium.
Okay.
If you take $200,000 of cash and park it in a single premium hybrid policy, that money is not gone. If you never require a single day of long-term care, your beneficiaries receive a tax-free death benefit.
Oh, wow. So it just functions as an estate transfer.
Exactly. The capital is simply parked in a different vehicle. But if you do trigger a care event, that same $200,000 premium creates massive morbidity leverage.
Meaning it pays out way more than you put in.
Right. It might unlock a pool of $500,000 or even $800,000 in tax-free long-term care benefits. You're basically trading a highly inefficient, taxable liquid asset for highly leveraged, tax-free protection.
That's incredible leverage. And because these are funded with a single lump sum or maybe a guaranteed short-term payment schedule like over 5 years, you completely eliminate that premium hike risk.
Precisely.
The insurance company can't suddenly demand higher payments when you turn 80, which, brings up the concept of lazy capital, because high net worth portfolios are full of it.
They really are. Every affluent portfolio has pockets of underperforming liquidity. It might be $500,000 sitting in low-yielding certificates of deposit, a money market account, or maybe an outdated, non-qualified annuity.
Just safe money sitting there doing nothing.
Right. It's money the family does not need for daily operational living expenses. So
Yeah.
you take that lazy capital and upgrade its efficiency. You move it into an asset-based long-term care vehicle.
And you still maintain control, right?
Yep. Since many of these contracts offer a surrender value if you change your mind. But you've instantly created this massive liquidity buffer if health goes sideways.
Okay, so that's individuals. What about married couples? Because paying for 2 of these massive policies seems like a lot of capital to tie up.
Yeah, that leverage becomes even more efficient when we look at how married couples structure these vehicles. Instead of buying 2 separate isolated policies, they utilize shared care pools.
Shared care pools, how does that work?
Well, statistically, it's incredibly rare for both spouses to suffer extended multi-year maximum benefit care events simultaneously. Usually one spouse requires significant prolonged care while the other might need very little.
Right, that makes sense.
By establishing a shared pool, say, a combined benefit of $1 million, either spouse can draw from it.
Oh, I see.
So if the husband requires $700,000 of care over 6 years, he isn't capped at a personal $500,000 limit. He pulls from the shared pool, maximizing the utility of every premium dollar spent while preserving the core portfolio for the healthy spouse.
That is so smart. Okay, let's step away from the specific insurance products for a minute, because from what I read in the Davies guide, liquidating cash isn't just about the loss of the underlying asset.
No.
It's about the collateral damage to the tax return. I was thinking about it like playing financial Jenga.
Ooh, I like that.
You pull out one block at the bottom to pay for a home health aid, and suddenly your Medicare premiums and tax brackets crash down on your head.
That is exactly what happens. Think of your tax structure like a terraced fountain. You've spent years carefully managing how much income flows into the top tier so it doesn't spill over into higher marginal brackets.
Right.
The moment you were forced to take an unbudgeted, massive distribution from a traditional IRA to pay for a health aid, you flood that fountain. Pulling an extra $150,000 of taxable income pushes you aggressively into the 32 or 35% federal tax brackets.
Which is brutal on its own. But the guide points out a more insidious trap: the cliff penalty of IRAA.
Yes, IRMA.
The income-related monthly adjustment amount. That forced distribution doesn't just bump your marginal bracket, it throws you off the IRMAA cliff, instantly causing your Medicare Part B and Part D premiums to just skyrocket.
It acts as a delayed financial time bomb, too, because of Medicare's 2-year look-back period.
Wait, a 2-year look back?
Yeah. The IRS uses your tax return from 2 years prior to determine your current Medicare premiums.
Oh, wow.
So a massive IRA withdrawal to pay for a care event in, say, 2026 will trigger punitive Medicare surcharges in 2028.
That is a nightmare.
And furthermore, if you're executing a multi-year Roth conversion ladder, methodically paying taxes now at historically low rates to create a tax-free bucket for later, that sudden surge in taxable income destroys your conversion space entirely.
Your carefully engineered Roth strategy is just completely neutralized by the care costs.
Exactly. So the long-term care policy acts as a firewall. By having the insurance company pay those costs with tax-free benefits, you retain absolute control over the timing and volume of your taxable distributions.
And that firewall concept extends directly to advanced estate planning too, doesn't it? Which is highly relevant right now due to the looming 2026 sunset of the Tax Cuts and Jobs Act.
Oh, it's huge. The historically high federal estate tax exemptions are scheduled to be cut in half in 2026. Wealthy families have spent the last few years and tens of thousands of dollars in legal fees setting up irrevocable trusts.
Right, like spousal lifetime access trusts, complex annual gifting strategies, just trying to shield their wealth from that impending tax clash.
But long-term care costs are paid with after-tax dollars. If you're burning through $180,000 a year for 6 years, you are draining over $1 million out of the estate.
After tax.
Yes. So the capital required to fund those perfectly engineered trusts just vanishes. The legal scaffolding remains, but the assets meant to populate it have been liquidated to pay the nursing facility.
That would be devastating. So the insurance benefit ensures the estate plan functions exactly as the attorneys designed it, regardless of the client's medical fate.
Exactly. And, there's also an offensive tax play here, specifically for business owners.
Oh, right. Because individual taxpayers really struggle to deduct long-term care premiums.
Right, because they're subject to a strict 7.5% adjusted gross income floor. But the corporate tax code offers a massive workaround.
So how does that work for, say, a C Corp?
Well, the tax code effectively subsidizes wealth protection for entrepreneurs. Under Section 162 of the Internal Revenue Code, a C corporation can typically deduct the absolute full cost of a long-term care premium as a legitimate business expense.
The full cost. Wow.
Yeah, and there are no age-based limits like there are for individuals.
So you're basically utilizing pre-tax corporate dollars to fund a personal asset protection vehicle.
Exactly. Now, S corporation owners and LLCs have slightly different mechanisms, but the underlying principle remains. The business entity absorbs the cost of defending the owner's personal balance sheet.
That's an incredible strategy. But none of these tax strategies, hybrid pools, or asset-based repositionings matter if the primary door is locked.
No, they don't.
The most urgent vulnerability outlined in the Davies Guide is the unforgiving reality of medical underwriting.
Yeah, this is where people really get caught off guard.
Right. I mean, I had this naive question when I first started reading. I thought, why can't I just wait until my doctor tells me my memory's slipping or my knees are shot to buy a policy?
You and everyone else. But the underwriting window for long-term care slams shut with zero warning. And the mechanics of this underwriting are drastically more restrictive than life insurance.
How so?
Well, from an actuary's perspective, a life insurance payout is a binary one-time event. They know they will pay out exactly once.
Right.
But long-term care represents an open-ended, multi-year bleed on the insurer's reserves. So the risk tolerance of the insurance company is practically zero.
So if you have like a minor issue, what happens?
If you show a slight hand tremor that suggests early-stage Parkinson's, or you have a history of a transient ischemic attack, a mini-stroke, or even if you just utilize a mobility aid, it is an automatic decline.
An automatic decline. They don't just offer you a policy with a higher premium?
No, they refuse to issue the contract entirely. Any notation of cognitive impairment in your medical records renders you permanently uninsurable.
Permanently. Wow. So the optimal window to secure this leverage is really between ages 50 and 65.
Yes. The sweet spot. Once you cross 70, the available product pool shrinks significantly. By 75, the hybrid vehicles are essentially non-existent or just mathematically prohibitive.
And this timing issue exposes some specific professional demographics to massive risk. I thought this part of the guide was fascinating. I can clearly see why professional athletes are vulnerable, given the physical toll of their careers.
Let's examine the athlete first. A professional athlete often exits their primary earning window in their mid-30s.
Right. Super young.
They've accumulated significant capital, sure, but they face a 50 to 60-year time horizon in retirement. Combine that unprecedented timeline with severe joint deterioration or the elevated risk of CTE, chronic traumatic encephalopathy from their sport, and early underwriting is critical.
They have to secure coverage before those occupational hazards morph into uninsurable pre-existing conditions.
Exactly.
But the other group surprised me, C-suite
Though
executives.
they face a huge liquidity trap.
Because their wealth is heavily concentrated, right? And deferred compensation packages, restricted stock units, private business equity.
That is the exact vulnerability. An executive's net worth might look phenomenal on paper, but a massive portion of it is illiquid. If a severe care event occurs during a trading blackout window, or right when the company's stock has taken a temporary 40% hit due to macro conditions,
They cannot easily liquidate.
no, they're trapped.
Mm-hmm.
The insurance policy provides an immediate, highly liquid buffer of cash, allowing their concentrated positions the time they need to mature or recover.
Okay, so for those listening who are in that 50 to 65 sweet spot and are ready to actually evaluate policies, the guide had some rapid-fire takeaways on what to look for, because the mechanics of the policy features dictate how effective the protection will actually be.
Right. And the most critical engine of any policy is the compound inflation protection. If you do not attach a compound inflation rider, you are buying a depreciating asset.
Because of that 5% healthcare inflation we talked about earlier.
Exactly. Utilizing the rule of 72, a 3% compound inflation rider will cause your daily benefit to double roughly every 24 years. So if you secure the policy at age 55, you need the mathematical certainty that the benefit will be twice as large when you actually enter a care facility at age 79.
That makes total sense. And you also have to leverage your own liquidity to lower the cost of the contract, right?
Yes.
This involves the elimination period, which functions basically like the deductible. It's the waiting period before the insurance company starts writing checks.
Right. A mass market consumer might need a short 30-day elimination period because they can't afford to self-fund a month of care. But a high net worth family has the liquidity to easily cash flow the first 90 or even 180 days of a care event.
So by accepting a longer elimination period, you drastically reduce the internal cost of the insurance.
Exactly. Creating a much more efficient use of capital.
Yeah.
And crucially, you have to verify the mechanics of the home care coverage.
Oh, right. Because affluent individuals overwhelmingly prefer to age in place.
Yes. Receiving customized care in their own residences rather than relocating to an institutional facility. The contract language must explicitly cover premium home health aides without restrictive facility mandates.
So the sum of all these mechanisms points back to the central philosophy of the Davies wealth management material. You are not making an insurance decision. You are making a foundational wealth preservation decision.
That's the core of it.
You're building a moat around your independence. You are shielding your spouse from the devastating psychological and financial burden of liquidating the life you built together.
True financial security requires acknowledging that accumulating assets is only the first half of the equation. The second half is defending those assets against forced liquidations, sequence of return risk, and the cascading tax penalties triggered by healthcare inflation. You must dictate the terms of your protection while you still possess the medical leverage to do so.
And whether you have $1 million, $10 million, or you're still building toward those numbers, the core lesson really applies. Which leaves us with a fascinating and, frankly, kind of lingering variable to consider regarding the future of legacy planning.
Yeah.
Medical science is advancing at a staggering pace, right? It's fundamentally expanding our physical lifespans and keeping our biological systems running decades longer than historical norms. But our independent health spans, our cognitive sharpness, and physical autonomy are not necessarily pacing those biological advancements.
They're just not.
So if you, or the generation above you, survive into a decade-long window requiring constant, intensive medical supervision, how will that single unbudgeted variable fundamentally rewrite the concept of generational wealth for your family tree?